Well, the dust settling after NVIDIA's solid but disappointing earnings reports by some measures. Now traders digesting the latest GDP data out today, showing the U.S. economy growing at a stronger pace than expected in the second quarter. To discuss what this means for broader markets, we've got Megan Horneman, who is the Verdence Capital Advisors CIO. Megan, great to have you back on the show with us. I mean, we know coming into today's trading activity, we were all going to be focused in on exactly what NVIDIA had to say, as it has been really the leader and contributor to so many of the gains that we've seen so far in 2024. But now, even with NVIDIA down by about 2% during today's trading activity and the major averages seeming to still hold on to gains, is this the broadening out that we've been talking about for so long?
I do think this rotation has some legs to it. I think you'll see that, especially as the earnings, not only for the last quarter, but even the next quarter come in, and these beating expectations by the numbers that we've beaten in the past. It's just not sustainable with that AI momentum trade. I think you'll see some broadening out until we get further evidence that the economy is slowing, and that's our concern. The GDP number that we got today, again, it was backward looking. It's very surprising to me that the consumer is still driving GDP, given the level of debt that they're carrying right now, as well as the high interest rates that are starting to filter into whether it's confidence or now delinquencies rising. I don't think that's very sustainable either. So I think as we get into the fourth quarter of this year, it's going to be a much slower economy. And I think some of this equity euphoria around rate cuts may lose some momentum.
Okay, so you're citing some of those risks that you see playing out in the market over the next few quarters here. But when you think about a name like NVIDIA and all the volatility that surrounds that, coupled with those risks that you were just outlining, how do you hedge your bets as an investor? How should people be operating in this environment, especially since we likely will be seeing a rate cut in September?
Well, first of all, when it comes to some of these names that have really driven the S&P 500 higher, make sure you're not overweight to where you want to be. So rebalance your portfolios. Make sure you're back in line where that allocation should be. Also have a good amount of cash on the sidelines to be able to put to work. When you look at some of the areas of the market, small and mid-cap stocks, they have caught up a little bit here lately, but they're still much weaker when you look at it compared to the large cap performance. These are the areas of the market that will rally the most out of an economic downturn. Those are some that we're looking to possibly add some money to. It's a little early yet because the economy is really just starting to show some weakness in the numbers that we've gotten. The best time to do that is when you've really, confirmed that we're well in a recession. They're going to be the best ones to rally out of that.
A much more popular acronym that we're continuing to hear is BOTD, buy on the dip. Where are the most attractive dips that you would be keeping an eye on, Megan?
So I think if you look at the S&P 500, we saw it a couple months ago where we had about an 8 or 9% decline. We saw small and mid caps down about a 5% decline. I still think we could be in for at least a 10% decline in the large cap indices. We'll look at that point. But the one thing that we need to see in conjunction with that decline is that they're getting a little bit more realistic on earnings expectations. Earnings expectations for 2025 are still way too unrealistic in our opinion. You can't have a slowing economy, a Fed that's cutting rates because we have a slowing economy, but yet have double-digit earnings growth for next year. So when we see earnings growth revisions come down, as well as that dip, that's when we'll look to put money to work.
PCE inflation data is out tomorrow. That's the Fed's preferred inflation gauge. Do you expect to see the trend of disinflation continuing? And when you take a step back, there are still some very sticky areas of inflation in this market, like core services and shelter. So what's the battle that the Fed faces when it comes to tackling that while also lowering rates?
It's a battle for sure. That's where I think the Fed has to be very careful about how dovish they deliver these rate cuts. If they get too dovish, it's very easy to reignite inflation, especially in those sticky areas, like you mentioned, in services. Service inflation is still growing well above average hourly earnings on a year-over-year basis, and well above what the Fed's comfort level would be. So they can cut rates. We think that that's definitely likely they'll do that, but they have to be very careful about how they walk that line on articulating whether this is one cut and then six cuts right after that, or if this is one cut and let's wait and see.
What do you believe that policy pathway could look like, the pacing of those cuts?
So, what I would like to see and what may happen are two different things. But I think that the Fed, can deliver a 25 basis point rate cut in September. I think that they should deliver a wait and see statement with that. I think that trying to articulate that they'll cut again in November and then again in December, it's way too early to say that. The labor market is weakening. We've seen that over the past 6 months with the unemployment rate rising. But on an absolute basis, the unemployment rate is still well below what we tend to see going into the first rate cut of a rate cutting cycle. And inflation, while it is starting to move in that direction and we're getting close, as I mentioned, there still is a lot of sticky inflation out there that could cause a bit of a headache here for the Fed. So they have to be very careful. I think they should deliver 25, a hawkish statement, and then just say, we'll wait and see. There's a lot of information between the September meeting and when they meet again in November.
Megan Horneman, who is the Verdence Capital Advisor CIO. Great to see you here. Great insights and analysis as always. Thanks, Megan.